Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax updates to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and will be licensable in July 2024. On this week's episode of Cross-Border Tax Talks, we're back in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to have Nita Asher back on the podcast. Nita is an international tax partner in PwC's Washington National Tax Services practice and former legislative counsel to the Joint Committee of Taxation during the enactment of the Tax Cuts and Jobs Act. Nita, welcome back to the podcast.
Thanks for having me, Doug.
So Nita, this is your fourth visit to the podcast, if my memory serves me correctly. You're on one of the very early podcasts that we recorded in my Washington, D.C. office at another building / makeshift podcast studio. And that was almost 5 years ago, if you can believe that.
Wow.
Oh, how time flies. Your second was during the pandemic, which we did virtually. I did not like doing those virtually. Oh, you did a very nice job. And then you also had the opportunity, I think slightly after the pandemic, if I'm allowed to say that, to record in my home studio in St. Louis. We're now back on your home turf here in our professional Policy on Demand studio here in DC. So my opening question for you, Nita, where's your favorite place to record a Cross-Border Tax Talks podcast?
Well, that's a tough question to answer, Doug, and I can't believe it's almost been 5 years.
Yeah.
If I had to pick a location, I too was not a fan of the virtual podcast.
No.
I would say your at-home studio. I was aware of people turning cars into campers during, the pandemic. I wasn't aware people were also turning their homes into a podcast studio for tax talks. And so if I had to pick one, I would say your St. Louis home studio would be my favorite.
Well, and I would agree. So I enjoy recording at home and avoid having to get on a plane. And the reason that I ended up building the podcast studio is because we had that recording equipment back in the other DC office when we were closing that DC office during the pandemic, and they didn't know where to ship the podcast actual hardware. So I said, send it home, and I had a little room above my garage with nothing in it, and turned that into the podcast studio.
Recycle, reuse.
Exactly. So that's the story. All right, so let's dive into the material here. In April of 2024, U.S. Treasury and the IRS released two sets of proposed regulations addressing the application of Section 4501, which is the excise tax that applies to repurchases of corporate stock by public companies. Those included both proposed procedural regulations and technical proposed regulations. And I want to note, before our non-U.S. listeners tune out, Nita, these latest developments are very relevant for non-U.S. parented public companies that have a U.S. subsidiary and engage in stock buyback. So that's going to be the hook for our non-U.S. listeners to continue to tune in. So with that, let's set the stage and kind of go back to the original enactment. The excise tax on stock repurchases was passed by U.S. Congress and signed into law by President Biden in August of 2022. Can you provide some background on the excise tax?
Happy to, Doug. Before we get into the weeds, the excise tax is a 1% non-deductible tax on certain stock repurchases. And as you noted, it was enacted into law back in 2022 as part of the Inflation Reduction Act and was used to pay for, in part, the carbon reduction credits and other incentives in that particular bill.
So you mentioned that there was obviously a need, this was a pay for the carbon reduction credits, green energy credits, whatever you want to refer to those as. Were there any policy statements or considerations underlying the enactment? Because then we'll get into the notice and then the regs, but any additional background beyond the legislative language that we got?
It's a really interesting question, Doug, and I believe you've had a prior cross-border tax talks on CAMT, where you all discussed the Inflation Reduction Act being a reconciliation bill and also not having underlying formal legislative history to provide the policy rationale and reasons for change, or in this case, enactment of the provision. Now, it's not the first time that there was a proposal to potentially tax stock repurchases. Back in 2021, I believe, there was a proposal to enact a similar excise tax. That one, instead of being 1%, was actually 2%. There has also been some commentary and academic papers surrounding this particular tax, and those commentaries note that there was some desire to put dividends on par with stock buybacks, and how stock buybacks can inflate the price or value of the stock that's not repurchased. And that particular appreciation is not taxed until the shareholders who don't have their shares repurchased actually sell them, whereas dividends are taxed, upon distribution. And so there is some discussion about parity, but once again, no formal legislative history underlying the stock buyback or CAMT.
And right now it is 1%, only applies on the actual buybacks. We'll get into some of the mechanics. And I believe in the most recent Biden proposal for the fiscal year 25 Green Book, I think they'd even suggested potentially increasing that excise tax. Do I have that correct?
You do have that correct, Doug. Another reason to keep listening to this podcast is we're already seeing proposals to increase the rate from 1%, maybe up to 4%. You talk to economists, and it's a really interesting economic sort of study to see at what point are you just going to temper the amount of share repurchases because of something such as this excise tax. And we're going to get into the details a bit more. I do want to note that, there are certain exceptions and de minimis exceptions that apply. But yes, you're absolutely correct. 1% may not be where the tax rests. And so I think it's emphasizing the importance to have the rules administered in the right fashion. As you noted, we're going to talk about some of the administrative guidance that we have received to date.
Yeah, and I will ask listeners to note that the likelihood of that Green Book proposal from Biden, as we've said before on these prior podcasts for this fiscal year, the likelihood of that going anywhere given our divided Congress is probably zero or slim to none. But something to keep in mind as we think about future administrations and, to the point that this is viewed as a pay for, it paid for these green energy credits, could some other future administration, whether it's Republican or Democrat, use this as a pay for to potentially increase that. So just something to keep an eye on.
It's another lever.
Exactly.
So you have the corporate tax rate, you have the CAMT rate, you have the rate on the international tax provisions. Now we have something else.
Yeah,
the excise
a new lever
tax rate.
from 2022.
Absolutely.
Okay, so let's get into the details a bit more. How is the excise tax base computed?
So the excise tax base, just generally, it's computed based on the fair market value of share repurchases during a given year, netted by certain issuances, including stock that's issued to employees. I do want to note that the netting rule is more limited in the foreign parented group context because you only net the amount of repurchases with stock that is actually issued to employees by the U.S. affiliate or specified affiliate, which we're going to talk about in more detail here. And the amount of repurchases have to be in excess of 1 million. There are other important exceptions that rely on sub-C principles that could, exclude certain deemed repurchases from being in the base. But it's effectively the net amount of repurchases less the issuances, and then you look to see if there are any other exceptions.
And that, what you refer to, that net is considered the netting rule.
That's correct.
And you said that there is kind of the floor is 1 million, presumably over the entire taxable year.
Correct.
Okay.
Correct.
So it's obviously needs to be a public company, but there's nothing for as far as revenue size or whatever. It's just if you do stock repurchases net of those stock issuances for 1 million USD, you're in the soup.
That's right.
Okay. So before we turn into the proposed regulations that were released in April of 2024, there was a notice that came out in 2023 that preceded these regulations. What were some of the takeaways from that notice? And then we'll get into how many of some of the comments from that notice and whether those were incorporated into the regs.
There were quite a few takeaways from the notice. I would say Notice 2023-2, which came out in December of 2022, it provided some helpful guidance on how you determine the fair market value of the repurchases. and also some helpful guidance on the netting rule, particularly how you apply the employee stock compensation rules and tax principles in this particular context. What was surprising was a funding rule that was announced by way of the notice. And that particular funding rule, I believe, is surprising because when you look at the statutory language, the statute typically applies the repurchase to repurchases of publicly traded domestic stock. And then there's a special rule that applies to foreign publicly traded stock. But that is where you have a U.S. affiliate of a foreign publicly traded company that is repurchasing the foreign publicly traded company's stock from a third party.
So where the U.S. sub is
Where
actually
the US
engaging
sub,
in the repurchase.
Exactly, which quite frankly you rarely see in practice.
Right.
And there's actually like jurisdictions that prohibit
Right.
a U.S. affiliate of a foreign pubco from actually owning stock or hook stock in this case. And but the statute is clear on how it applies this rule in the foreign publicly traded context. That being said, you can appreciate Treasury and the IRS thinking about ways you could have, prior to enactment, a U.S. subsidiary that's repurchasing foreign publicly traded stock, and then post-enactment, instead of engaging in a repurchase, they are funding a repurchase. And so we saw in the notice a funding rule, broadly worded, that essentially would look to a U.S. affiliate funding by any means, and this includes distributions, capital contributions, debt, of a repurchase, either from the foreign publicly traded company itself or an affiliate of foreign publicly traded stock from the market, if that funding had the principal purpose of avoiding the excise tax. Once again, my example, simple example, prior to enactment, U.S. sub was engaging in repurchases, and post, they're funding the repurchases in some other manner.
So a dividend or a loan up to the foreign
Correct.
parent to then buy the stock.
Correct. There was also a per se rule, and the per se rule would deem a principal purpose to exist if you had a funding 2 years within a repurchase of foreign publicly traded stock. And I have to say, Doug, there was a flurry of commentary
Sure.
on the per se rule and how a funding by any means, once again, very broad, within 2 years of a repurchase could be swept up by this funding rule. And so taxpayers commented on the notice on the funding rule, and we received some changes recently. Okay,
which is good. And but this is why our foreign listeners that have a U.S. subsidiary need to pay attention. If you're public and you're buying back stock and you have a U.S. sub, that per se rule that would have said, well, if you've done a dividend within 2 years of a stock repurchase, that you're going to be subject to that 1% excise tax, that has been changed. But we'll talk about the mechanics of what actually was enacted. So let's first dive into the proposed procedural regulations. Can you describe some of those key takeaways from that proposed regulation package?
Yes, we've received some procedural guidance post-enactment, and actually taxpayers haven't had to report or actually pay the quarterly excise tax payments to date. I think it's important to note that those amounts are accruing. There just isn't a requirement to report and pay at this point in time. And what we received in one of the proposed reg packages, the procedural package, is a further moratorium, if you will, on payment and reporting. But we now know that taxpayers are going to have to actually file an excise tax return. This is the Form 720. Mm-hmm. And this is even if, Doug, the repurchases qualify for an exception in full or are offset by the netting rule that we discussed earlier, there is still going to be a requirement to fill out the form.
Oh, so you have to effectively report
Exactly.
gross and
Exactly.
then net, even if there's no. So if you have any stock repurchase, taxpayers are still going to have to file.
And there's an additional form that you attach to the Form 720. This is the 7208 that is going to provide your calculation. So it's going to be a reporting exercise, and we all know that taxpayers have a lot to report and keep track of these days. Something else, to the extent you have a repurchase, you're going to have to report. And what we also know is, from a timing perspective, there's some helpful examples in the procedural guidance, and it looks like the earliest taxpayers would have to report and pay would be October of this year, but it's likely going to be something that we'll see spilling over into 2025. And this is because the reporting and payment date is tied to the publication of the final regulations. And so that's going to determine which quarterly excise tax return you're going to have to provide the information and make the payment with.
So it's the first quarter after the final regs
Correct.
are published.
Right.
And so I think, assuming that this gets published in the fall, right, then I think the likelihood would be that most taxpayers, well, I guess it doesn't matter if you're calendar year, assuming you're on a traditional quarter, would be April of 2025.
That's correct.
And so but the important thing that I think for listeners to note is that this will be a potential multi-period filing, right? Because there hasn't been a prior filing. So to your point, this tax should be accruing. And if this applies to public companies, they need to be providing for that from a financial statement perspective, but then the form and then the actual check that they'll have to write for potentially multiple periods would be, assuming the timeline holds, in April of 2025.
Yeah, the accrual is important to note. I think there's also an incentive for Treasury and IRS to finalize these regulations as well. They want to see the revenue. They want to utilize that revenue for the incentives that they have been providing to taxpayers too. And so I know oftentimes we get questions, when do we think guidance is going to be released? And we can never definitively say, but I think there's incentive to finalize these regs and actually start collecting the revenue.
And it has been a couple years, right? And obviously the Treasury wants its money, and so they would seem to have reason to get these things finalized, obviously after the notice and comment period. All right, so let's talk about the technical proposed regulations. What are some of the key takeaways from that? And I know there was quite a bit in there.
It's quite a bit in there. It's quite lengthy, even though the statute is rather slim. But for the most part, I would say the rules regarding repurchases, the valuation, employee comp, those were reflected or consistent with what was in the notice 2023-2. Prior to release of the proposed regulations, Treasury was, on panels and indicating that they were going to make changes to the funding rule, which we discussed. And thankfully, they did make certain changes. I think the one thing that taxpayers were happy to see was the elimination of the per se rule. Yep. But with that helpful change, one might say they made certain interesting changes to the general funding rule. And I say that because the funding by any means, the broad language remains extremely, broad and applies to distributions, capital contributions, and debt, and other types of funding. But what was really interesting is that they included some language regarding funding by any means and indirect or direct repurchase of foreign publicly traded stock. And you have to do that with in a principal purpose of avoiding the excise tax is deemed to exist if you have an indirect or direct funding of a repurchase. And what in the notice was being viewed as a scenario where you are intending to avoid the excise tax has now shifted to, is there a principal purpose of funding a repurchase? And that is presumed to be enough to deem a U.S. affiliate of having a principal purpose of avoiding the excise tax. And I can tell you, Doug, that's causing a lot of concern because of the broad language in the proposed regulation. There was a Treasury press release that indicated the changes to the funding rule from the notice to the proposed regulations would take ordinary course business transactions out of a potential, funding of a stock repurchase. But what we don't see is any clear exception for ordinary course business transactions.
Like what that actually means.
Exactly. And furthermore, all of the examples presume a principal purpose to fund a repurchase to exist instead of something slightly more helpful that taxpayers can look to say, all right, we have a situation or example where there has been some sort of intercompany transaction or event that doesn't constitute a principal purpose of funding a repurchase and thus avoiding the excise tax that they can hang their hat on.
Yeah, I mean, one can imagine a scenario, for example, Nita, and I've had the opportunity to work with a lot of treasurers over the course of my career advising.
Great people.
Absolutely, advising publicly traded multinationals. One could imagine a scenario where a non-U.S. parented group, the treasurer, sends out a note to his or her treasurers or finance team around the globe saying, hey, we need cash because we are funding a stock repurchase. And if they have a U.S. affiliate that is otherwise normally paying dividends, how can you define whether that was in the ordinary course? Maybe it's because they've done it the same year. One of the challenges when they have these types of broad rules related to funding, in particular in a principal purpose, is the fact that cash is fungible. And, identifying which dollar of cash came from a potential dividend or a loan or the lack of payment on presumably a service type payment, or maybe that's an ordinary business transaction. But you can imagine a lot of uncertainty for taxpayers trying to figure out, well, was this part of the reason for a particular transaction to fund a treasurer's need to make a stock repurchase at a non-U.S. parented group? Right.
There's a lot of practical issues with the way the funding rules drafted and the fungibility point. That's acknowledged in the preamble to the proposed regulations, which was part of the reason why Treasury didn't propose a tracing rule, which we all can appreciate. It's just difficult when you don't have any sort of helpful examples, exceptions for short-term lendings, things that taxpayers enter into for no tax reasons whatsoever. Cash pooling oftentimes is tax inefficient. Mm-hmm. It's just a way to collect cash and deploy it at its highest and best use in an efficient manner. And we just don't have anything here for taxpayers to rely on.
So let me test that, because there are a number, obviously, of other kind of quote unquote funding rules that we find within the U.S. international tax system. There's the regulations under our deemed dividend rules under Section 304 for my wonky U.S. tax folks that are listening. Our debt equity rules under Section 385 have some funding, and then there's our Section 965, which is part of Subpart F, that deals with investments in U.S. property by controlled foreign corporations. There's also a funding rule there. How, if at all, is the funding rule in the proposed regulations in the context of the stock buyback any different, or is there anything we can learn or borrow from some of those other provisions?
And some of those provisions are actually referred to in the preamble to the proposed excise tax regulations as well. And I'm going to start off by saying, Doug, the provisions that you noted, the funding rules and other contexts, they are also broadly worded.
Yes, they are.
And some of them have exceptions, but what we see in practice, or sometimes those exceptions are not helpful. It's very curious to see if anyone can rely on some of the exceptions. 385 comes to mind. Some of the short-term lending exceptions are just not as useful as taxpayers want to see. So I don't think we should be borrowing necessarily from those other provisions. What is helpful in other respects, I would say a couple of things. Examples where you could see appropriately, priced intercompany transactions that are entered into in the ordinary course. You'll have an example saying this does not constitute a funding. Once again, we don't have that here with the excise tax. All of the examples are presumed to, fund a repurchase of stock. Something that you brought up earlier, Doug, when, with your work with treasurers, both domestically, abroad, for foreign parented groups, the U.S. oftentimes has no control over where its cash is going.
Yeah.
And the repurchase, all the decision, all the documentation is made at the level of the publicly traded foreign parent. It is unclear whose intent matters under this principal purpose test. Is it the principal purpose of the U.S. and where they're putting the cash? Because there could be a repatriation, mandate by the foreign parent to every year you have to distribute excess cash so they can use it, not realizing that something's going on at the parent level that is linking that U.S. cash to a repurchase when the U.S. affiliate has, no intent for that to be the case. And so having exceptions, having examples that take into account the lack of, control and visibility of the cash and these other funding rules that you mentioned, oftentimes the U.S. does have control over the transaction or what the funds are going to be used for. Here, I think it's different, and thus we should have some helpful examples to acknowledge the difference. It was interesting, comments on the notice referenced in certain cases the treaty aspects of the funding rule, and this is the funding rule set forth in the notice. And the preamble to the proposed regs did acknowledge those comments, but said, one, it's an excise tax, not an income tax. And two, they didn't think there was an issue because of the elimination of the per se rule. And we're grateful that the per se rule has been eliminated, but I also think that there's, the right to tax issue looms in the air with this particular funding rule too. I should also note that while the per se rule was eliminated, there is a new rebuttable presumption in the proposed regulations, and we saw in the administration's green book some foreshadowing of a rule that was going to apply to downstream funding. So when you have, say, foreign publicly traded company with a U.S. subsidiary funds a lower tier subsidiary, which in turn repurchases the foreign pubco stock from third parties. That downstream funding is going to be deemed to have a principal purpose of avoiding the excise tax unless the U.S. affiliate presents clear and convincing evidence that the funding downstream was used for another purpose. I can appreciate that rule. Likely won't see that happening in practice, but that is a new rebuttable presumption that's going to put the onus on the U.S. affiliate to, explain why they're making that funding.
Yeah, just one bit of commentary as I certainly, understand why Congress did that rule, but just to go back to the point that you made earlier, that the number of times that I've seen a U.S. subsidiary of a foreign parent engage in a purchase of foreign parent stock, I'm not sure I can remember that particular situation. So it is kind of interesting that was the primary rule that was targeted by Congress. And now, if I think, again, the likelihood of a sub of the U.S. with a foreign parented group acquiring the stock is just as low. But now the real risk, obviously, is if the U.S. is somehow funding, the foreign parent whenever they're doing stock buybacks, and how the practically speaking, does a U.S. subsidiary sort of monitor that and determine whether that was a principal purpose, can be very challenging. So, Nita, what should these inbound companies, the non-U.S. parented groups, consider as we await final regulations? I mean, any kind of practical tips or things that they should be considering?
The comment period for comments on the procedural proposed regs ends June 11th, but as we noted, there is a sense of urgency to finalize the regulations and start collecting the tax. Documentation, contemporaneous documentation, cash is moving throughout these organizations, minute by minute,
Right.
Doug. And if you think about ordinary course sales, ordinary course, services that are undertaking in one organization, cash pooling, loans that were implemented well before the excise tax, there's no grandfathering. I think anything the foreign parented companies can do to document contemporaneous any new transactions and going back to see if there's any documentation surrounding the prior transactions to start pulling together a file.
Yeah.
It's a principal purpose test, which I can appreciate those tests are hard to actually administer and audit from the government's perspective. And I think it's going to be important for taxpayers to just start building files.
As well as for financial statement audit,
Exactly.
which will be more timely
Exactly.
than actual governments.
And, I'm glad that you took us back to the statute a little bit earlier ago. I just get very heated about what's in the administrative guidance. There is a special statutory rule for surrogate foreign corporations. So that's within the meaning of 7874, where you have a combination of a U.S. entity and a foreign entity. And while the foreign entity is not treated as a domestic entity as such, it's viewed as a surrogate foreign corporation. Right. And there's a separate set of rules, which it's really interesting because there are arguments about how the funding rule exceeds the congressional intent, because there was a separate statutory rule that addresses repurchases of surrogate foreign corporation stock. But once again, we don't have formal legislative history to understand that particular aspect of statutory construction here. But documentation, it's always better to do it contemporaneously, comment, and see where this goes. Because as you also noted, 1% may not seem like a lot right now, but if the rate goes up to 2, 3, 4%, it could start having a material impact.
It's another lever to your point earlier. So we spent a lot of time talking about the funding rule. There's obviously a lot more in those particular in the regulation packages. I will note from going through those regulation packages, and I think this is really kind of a common theme that we're seeing from Treasury on these reg packages, that there are a lot of comments that were obviously provided in the notice, a lot of time in the proposed regs going through those specific comments, and just a general theme. And there were certainly some of the comments were listened to, but a lot of comments, there's just a lot of explanation of why those comments were not incorporated. Any other kind of key things to think about beyond the funding rule for taxpayers?
Beyond the funding rule, making sure that you appreciate the application of the netting rule. It really is for domestic companies. It's a mathematical exercise to make sure you're applying the netting rule the right way. The fact that the proposed regulations utilize U.S. tax principles for the exceptions, it's helpful in one respect, but this is also an excise tax. So it's sort of a commingling of concepts here, reaching out to sub-C specialists to make sure that you're actually, taking advantage of the exceptions set forth in the statute and the administrative guidance.
So to the extent that you're doing some sort of deal and some sort of combination,
absolutely.
Anytime equity is involved in some form of, whether it's combination or a split up, split off, you need to be able to make sure that you can meet the exceptions and you don't trip yourself into this 1% excise tax on what may otherwise be a tax-free transaction or something that otherwise wouldn't be subject to this 1% excise tax.
That's correct.
So are other countries responding to this? This is kind of this common theme that we're starting to see now, where one country implements a particular rule. Anything else you're seeing outside the U.S. and kind of response to the U.S.'s excise tax?
Other countries are for sure watching and are interested. Canada has announced that they are going to enact a similar tax. I think it puts Canadian parented groups at perhaps a further disadvantage if the funding rule doesn't get narrowed even more so, because there is real risk of double taxation. I believe we're hearing that certain jurisdictions in Europe, perhaps France, they're also considering an excise tax. So seeing how this rule is going to be administered. And Doug, I know you've had podcasts where you talk about revenue raisers that are going to be needed in the near future,
Right.
2025. This is another lever. So, stay tuned to see if other countries, in addition to Canada, enact something similar. And I think they're waiting to see how it's going to be administered.
Well, usually stay tuned is my line, but you did it so well, Nita.
Beat you to the
Beat me
punchline.
to the punch. So thank you very much. I mean, this is really fascinating. And again, it's one of these areas that it's very kind of wonky U.S. international tax, but obviously big implications for U.S. public companies that are doing stock buybacks. I think many of them have their heads around the rules. But I think the big trap and the big takeaway is for those non-U.S. parented groups, a number of pitfalls and things to be mindful of. And I think the advice that you gave specifically with respect to being proactive, documenting, working with financial statement auditors will be very important. So thank you very much.
Thank you, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Nita Asher, partner in PwC's Washington National Tax Services practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.